Hi, everyone. This is Daniela Cambone with a quick message before we get to our segment today that this will be our last interview before we take a bit of a holiday break. We will resume the show on January 3rd. And I just want to say we've been getting so many emails regarding our Outlook series. So if you have questions, I know a lot of the topics are complex. Maybe you want to discuss some of them. You can absolutely do so by booking an appointment with one of my colleagues over at ITM Trading. There's the Calendly link in our description. So feel free if you want to talk strategy or how to prepare for 2024. Someone will be happy to discuss that with you. And before we get to our segment, I just want to wish all of you a very Merry Christmas, Bon Natale, Joyeuse Fête, in any language, a wonderful holiday season. Let's get to today's show. Hi, this is Daniela Cambone, and welcome back to the Outlook series here on the Daniela Cambone Show at ITM Trading. Well, this will be our last Outlook before we take a little bit of a holiday hiatus. So we're going out with a bang today, folks. Please welcome to the show, George Gammon of the Rebel Capitalist. George, so good to see you.
It's great to see you too. Congratulations on the move to ITM. I'm excited for it. I love Lynette, so you got to tell her hi for me.
Who doesn't? I mean, how do you not love anyone who's met Lynette? Absolutely adores Lynette.
That's right.
Very, very happy to be here, and I can't wait to start the new year with ITM. We're going to do incredible things. That said, let's get George Gammon's thoughts on a variety of topics, and most importantly, I want to get your thoughts on how you're preparing for the new year. I know you're hosting a big bash tonight for all your employees, ready to already ring in the holiday season. But let's start with what we heard from Jerome Powell, which shocked many, how he alluded that we will get rate cuts in 2024, right? I say alluded because now a lot of Fed officials are doing some PR damage control here, if you want to say damage control, backtracking a little bit, saying, well, maybe we got ahead of ourselves, or maybe things were misinterpreted, or we didn't really say they were coming that quickly. So they're obviously trying to rein in what was said.
Yeah.
Why?
I think we've got to back up and understand that nowadays all the central bankers, they're all central planners, and they're all, I think, communicate with one another, and it's all premeditated. What the ECB says, the Bank of England, the BOJ, the Fed, I think they all kind of, have their little powwow and determine, what direction we need to go, or what does the rhetoric need to look like? What's the narrative that we need to push? And as of the last, let's just call it year, they've all been on this. We got to tackle inflation. We got to tackle inflation higher for longer, higher for longer. I think they are doing that really to talk down the markets, to try to maybe increase unemployment. And in their minds, that's going to bring down the rate of inflation to their target, let's say 2%. But what was astonishing, really, is that Jerome Powell came out the other day and basically implied that we've got this Powell pivot now, once again, and he went from being very hawkish with his rhetoric to quite dovish. But, we as American investors focus exclusively on Jerome Powell, but I think we've got to look at what the ECB is doing and also what the Bank of England. And when you look at their rhetoric, they've came out and made public appearances since Jerome Powell came out, and they're still very, very hawkish. So for me, that's interesting, because why all of a sudden are they delivering a message that's different when they're almost always on the same page, but behind the scenes, they're talking amongst one another, and everything that they do is pre-planned. So I think you've got one of two options here. And again, I'm just speculating. I don't have any proof of this. I'm just trying to use some common sense and connect some dots here. But I think that behind the scenes, Jerome Powell is really freaked out about one of two things. Either the U.S. economy, he has information, he has intel that we don't have access to, that's telling him that the economy is way, way, way weaker than he thought. And this has changed over the last, let's say, even the last couple of weeks. So this has happened very recently. Or he's worried about the dollar. He's getting information from other central bankers that the dollar, even though it's gone down recently, still anything over 100. And a lot of these other countries are having huge problems. I think one of those countries could be China right now. And that they've got to give them some, they've got to throw them a life raft, basically. They've got to give them some way to get out of this pressure of having the dollar at over 100. Let's say it's dollar-denominated debt, whatever the reason may be. To me, those are the only things that make sense, because you've got to look at this through the lens of psychology. Sure, Jerome Powell can come out and say that he's got the mandate for this and the mandate for that, but at the end of the day, he's human. And he's also, what, I think 65, maybe in his upper 60s. This is kind of his last hurrah. So history is going to remember Jerome Powell as either Arthur Burns or Paul Volcker. And you've got to put yourself in his shoes. He's thinking about that daily. He has to be. There's no way that that's not going into his decision-making process, even if it's just subconsciously. How are his grandkids, how are his great-grandkids going to remember him, And I think unjustly, we look at Arthur Burns as kind of just a spineless weakling. And then you've got Paul Volcker as this cigar-smoking, legend that's in there that had the balls to do what it took to get inflation down. So obviously, Jerome Powell wants to be remembered more so as Paul Volcker. So you've got to think about that. Looking at it through that framework, he still, Daniela, came out with this pivot when inflation is still above 3%. So again, that tells me that there is a huge, huge problem that he knows about that he's not admitting to. Now, whether that problem, again, is the dollar being over 100 or the U.S. economy is tanking right now, I don't know. The yield curve would imply it could be both.
Okay. Really good points. I want to throw in a third one for you. Speculating, of course. 2024 is an election year. Now, of course, the Fed is an independent body. But 3 cuts, wouldn't that greatly help the Biden administration? Possibly get that soft landing?
Look, if they're going to cut by 75 basis points, is that really going to improve the economy? Maybe. Now, again, let me back up here. If we had a normal looking yield curve, Daniela, if Fed funds was at 5.25%, and let's say the 10-year yield was at 7% or 7.5, yeah, I think there's some merit to that. But right now, the 10-year Treasury yield is under 4%. We've got most people, I think, they kind of gloss over that. And for me, that's the most important thing. And it's shocking that a lot of these experts in the mainstream financial media, they kind of ignore this elephant in the room. And that's the inversion of the curve. And it's not just inverted, for heaven's sakes. The 10-year Treasury yield is over 125 basis points under Fed funds, the overnight rate. So show me the last time we had a 125-point inversion, and that ended well, right? So again, I think Jerome Powell, he's not stupid, and he understands that the bond market, the Treasury market, is screaming at him hard landing. It's not saying soft landing, no landing. It's screaming hard landing, recession, depression, financial crisis, collapse, whatever you want to call it. That's the message. And he knows that the bond market, the Treasury market, is almost right every single time. I'd like to remind your viewers that we have never had a recession, or every single recession that we have had since 1950 has been preceded by an inversion of the curve. And right now, we've had the most extreme inversion that we've almost ever seen.
Wasn't the bond market clearly indicating, George, that the Fed is done?
I don't think. You've got to ask yourself, it's kind of like a chicken or egg type question. And a lot of people think that the bond market is predicting what the Fed is going to do. I don't see it that way. I think the bond market is signaling what the health of the economy is. And that they're signaling that the health of the U.S. economy, and the global economy for that matter, is extremely poor, extremely poor. And therefore, the risk of recession is extremely high. So that's what the bond market's betting on. And does that mean that the Fed's likely going to cut rates? Yes, it does. But I think first and foremost, it's a signal on the economy, not necessarily the
I
Fed.
want to just dig a little deeper on that, because this is it's just fun to do. Speculating, of course, that if he did see data that absolutely terrified him, right? What would that be if it's not the dollar?
What would the data be?
Yeah, that would terrify him so much that he had to come out and say this.
I think the 2-year Treasury going down
Okay.
by 40 basis points the other day. I mean, just, prior to the meeting, I think there was some slight, I forgot what the news was that came out, but it was relatively dovish, right? And we saw the 2-year Treasury yield, which usually the Fed follows. I mean, if you pull up a chart of the 2-year Treasury yield and Fed funds, it's like the Fed funds lags it by like 6 months. I mean, it's almost in lockstep. So I think that he saw the 2-year Treasury the other day go down. I believe it was from it was 475. I don't have the chart in front of me, but it dropped by like 40 basis points in one day. I mean, that is almost unprecedented. And so he's looking at that and saying, whoa, 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 whoa. Maybe, we're not heading for a no landing. Maybe we're heading for a crash landing. But you also have to understand that these regional Fed banks, Danielle, they get a lot of information. They do a lot of surveys from local businesses, from commercial banks, and, all these things. So I think they call it the brown book. They aggregate that data into, or the beige book, something like that. So he has access to that boots on the ground intel as well. So he's probably looking at that, combining it with the macro, and then looking at what's happened with rates and the price signal that he's getting from the bond market. And that's what likely has him spooked, if it's not all these other central banks calling him about the dollar, which
Yeah.
Or maybe it could be both.
So let's go there a second, because Bloomberg had a report this week that Goldman, hedge funds, bearish now the U.S. dollar. I mean, here's a headline we don't see often. I mean, yeah, we have Fidelity that's bullish, thinking that the U.S. will still be the strongest, game in town. But the fact that a lot of people are turning bearish the U.S. dollar, and I mean, look, China should trim U.S. Treasury holdings, another headline from a former PBOC advisor. So has the weaponization of the dollar finally come to, is it going to start backfiring now on the U.S.?
No, I think the reason you see the dollar go down is just rate differentials. I think that's all there is to it. I think that the market's reading that as though the Fed is going to lower rates, and the ECB, Bank of England, might be a little more hawkish. We've got to remember the DXY. That's how I'm measuring it. It's like 57% euro. So I think it's just, in the short term, rate differentials can really move currencies. I don't know how much that really applies over the long run. But in the short term, I think that's what's driving the dollar down. It's just that the Fed, it's the prediction. It's what you're seeing in the bond market as well. The prediction that the Fed is going to drop rates, ECB, BOJ, the Bank of England might hold off a little longer, and therefore strengthen those currencies a little more relative to the dollar. But you've got to ask yourself, do you think the probabilities are highest, or what's your base case? Is it going to be no landing, soft landing, or is it going to be hard landing? Because if your base case is hard landing, then you've got to be a little bit more bullish on the dollar, right? And maybe in the short term it goes down, but if we have a GFC type of event, that's likely going to be bullish for the dollar. Now, over the long run, who knows? It depends on what the central planners, how they respond to it.
Well, I was going to ask you, I mean, for the folks, in the audience that are new to your thoughts on the U.S. dollar, I mean, we obviously had many experts come on calling for the fall of the almighty dollar. I mean, where does George Gammon fit in that?
No. Well, could the dollar go down? And again, let's just look at the DXY. Could it go down to 70 or something? Sure. But I think the probability of it going to 130 is higher than it going to 70. And the reason I say that is because of the way the global monetary system is structured, right? I don't want to get too into the nuance. Unless you want to get into the weeds, I'm happy to get into the weeds with you. But I don't want to bore your viewers.
if we, no, no, no. But I guess if we keep it high level, I mean, we obviously see all the headlines of, you know, dumping the dollars, or, you know, the strength of the BRICS. I mean, these are concern. I mean, I guess it's not a concern for you in 2024.
No, it's a structural issue that you have to think through, right? So Daniela, you know this well, but we'll just go over it. We'll keep it super simple for your viewers. If you get a mortgage tomorrow for $500,000, all else being equal, the money supply has gone up by $500,000, right? Because those currency units were lent into existence. Now, if I lend you $500,000 bills, now all of a sudden M2 did not increase, right? Because those currency units already were in existence. Now, let's just assume for a moment that you decide not to buy the house. So you pay back that $500,000 the bank just lent you the very next day. Then what happens to the amount of currency units? It goes right back down to where it began, right? So those currency units were created when the debt was created, and then they were destroyed when the debt was paid off. Now, again, let's go back and use that example of me lending you 500,000 $1 bills. No money was created to begin with, right? Well, when they printed it, it was created, but it's not when I lent it to you. And then when you pay me back the next day, those 500,000 $1 bills still exist, right? So it's much, much, much different when M2 money supply, the majority of M2 money supply, is dollar bills versus dollars that are created by a bank by lending them into existence. So now let's look at this. And now that we understand that dynamic, now let's go ahead and think about this. Let's assume for a moment that Saudi Arabia came out tomorrow and said, okay, we're no longer accepting dollars for our oil. We're going to accept yuan or whatever it is. And therefore, let's just assume that demand for dollars decreased by $10 trillion, just to keep the math easy, right? And let's also assume that if you look at the aggregate balance sheet of everything outside the United States, let's say we've got $70 trillion on balance sheets outside of the United States. Now, those $70 trillion were lent into existence. So let's assume that the demand goes down by $10 trillion. What would that do to the supply of dollars? It's going to bring it down by 10 trillion. Because what's going to happen is you've got that $10 trillion, or excuse me, the $70 trillion worth of dollar-denominated debt. Now, if no one wants those $10 trillion, they don't just, they don't just keep circulating. What happens is they go onto some balance sheet that actually owes the debt. And they say, we don't want these $10 trillion anymore. We're just going to continue to do business in the ruble. We're going to do the yuan. We don't want to be held hostage to the United States through the SWIFT system, whatever. So we're just going to go ahead and take these $10 trillion that we don't want anymore, but we still have the liability. We still have the $10 trillion worth of debt, right? So they take those $10 trillion, they pay off the debt. What does that do? That decreases the supply of dollars by $10 trillion. You see, so effectively, it's really weird, and it's tough for people to get their head around. But the bottom line is that when you have the majority of currency units being lent into existence, let's say we had a pie chart of all the dollars globally compared to all of the Argentinian pesos, right? That pie chart is going to look a lot different for the dollar than the Argentinian peso, meaning that there's a much larger percentage of Argentinian pesos that are literally pieces of paper, or they were printed into existence, versus the dollar, where the vast majority of them, especially outside of the United States, were lent into existence.
Okay.
And that makes all the difference in the world.
Okay, so I guess that's your answer when people say, well, why can't what happened in Argentina happen in the United States? Why isn't that a likelihood?
Yeah, so let's just, again, go through that thought experiment. So let's assume that the $10 trillion that nobody wants anymore, they sell those dollars, they buy rubles or buy yuan, buy gold, whatever. And the argument there is, well, oh my gosh, all those $10 trillion, those will come right, they'll flood into the United States because no one wants them anymore. And it'll create hyperinflation in the United States. You got $10 trillion coming in. Well, that's true. That's absolutely true. But it doesn't mean that the dollar goes down versus other currencies. Because think about that, Daniela, you would still have the $70 trillion worth of dollar-denominated debt. Therefore, the $70 trillion worth of liabilities outside of the United States. But now, all of a sudden, instead of having $70 trillion on the asset side of the balance sheet, you only have 60, because 10 trillion of those dollars are now circulating inside the United States. So now think about the equilibrium. Instead of having 70 trillion on the asset side and 70 trillion on the liability side, now you only have 60 trillion on the asset side. So if that happened, it is true that you would see some serious consumer price inflation in the United States, but you would also see the dollar skyrocket relative to other currencies, because you still have that intrinsic demand for those dollars because they were lent into existence. And that dollar-denominated debt is still a liability that has to be paid off.
But you can have a strong dollar, but doesn't mean it's a healthy economy. It's just
correct.
masking.
Correct. And if your viewers want an example of this, just look at the last 20 years. Just pull up a chart of the DXY, right, and then pull up a chart, or let's look at the last couple of years. That's the best example, because if you look at the dollar in 2019, it's higher today than it was in 2019, while at the same time, we had consumer price inflation skyrocket in the United States, up over 9%. So while consumer price inflation was going up in the United States during 2021 and 2022, the United States dollar on the DXY was going up in value relative to other currencies. That's very difficult for people to get their head around, that the dollar outside of the United States, it's like a completely different currency. You got to treat it as though it's its own thing. And that can appreciate very rapidly, and that can appreciate greatly against other currencies, while, oddly enough, it's losing value relative to goods and services in the United States.
You mentioned money supply before, and we saw the headlines, money, M2 shrinking at its fastest pace since the Great Depression. What are your thoughts? I mean, is this something that we should be paying more attention to? And what is it indicating here?
Now you're really getting into some nuance here, Danielle. It is true that M2 money supply has been going down, and we haven't seen anything like this since the Great Depression. So that in and of itself should be concerning. Maybe that's what Jerome Powell is looking at. But what's interesting about the M2 money supply going down is it's not like those currency units are just really all together, or it's not like the purchasing power is going down. What I mean by that, if you look at what's actually causing that, it's people taking savings and buying treasuries, or people, let's say non-bank entities, taking savings and turning that into treasuries. So the balance sheet, the asset
Right.
side of the balance sheet, really doesn't change. It's basically a cash equivalent. But what you're doing is you're swapping those dollars out for treasuries. So those dollars go into Janet Yellen's account, the TGA, and then she uses those dollars to pay off the Fed, because they have treasuries that are maturing because they're doing quantitative tightening. You see? So once Janet Yellen takes those currency units and uses them to pay the Fed with those treasuries that are maturing, those currency units go to M2 heaven. They're no longer there. They don't exist anymore. But those currency units were replaced by a treasury. So it is true that M2 goes down, but
always create? So won't they always create a scenario, because that benefits them, right? Taking the savings, moving into treasury. So won't they create that dynamic because it's feeding them?
Well, I think what your viewers have to be most cognizant of when we're talking about taking savings and turning it into treasuries, or taking savings and turning it into checking. That's another thing that I talk about on my channel all the time. I think that's a much, much bigger deal, because it impacts velocity. Because when you're taking savings and turning it into treasury, it's really no different, right? Because it's not like you're taking the money that was in your savings account and using it to buy food or buy energy or buy housing. No, it's just sitting in your bank account. It's just sitting on the asset side of your balance sheet, just like a treasury would. So to me, it's almost identical. Now, where it really changes, Danielle, is when the government starts doing deficit spending, and now all of a sudden they're taking the savings, they're turning it into treasuries, but then they're taking those savings, and instead of paying off the Fed, they're spending the savings into the economy, let's say with stimmy checks, and that takes savings and turns it into checking, right? And when you take savings M2 and turning it into checking account M2, you're going to increase velocity. And that is going to be a huge tailwind for consumer price inflation. And I think that's one of the reasons why we saw the CPI get up to 9%, because the government was doing all this deficit spending. And even if the Fed was not doing quantitative easing at the time, I still think you would have had significant consumer price inflation, because velocity going up by taking that check, by taking the savings and turning it into checking.
I want to talk the banks a second here, because I know when the crisis first broke, you and I did many interviews and deep dives into that. Here we are heading into a new year. I mean, we kind of stopped talking about, well, not us, but mainstream media stopped kind of covering the state of the health of the banking sector. I guess my question to you, George, is: do you trust the banks? That's a loaded one.
Yeah. Well, that is a good question. I would trust the banks if the government was not so involved. I mean, right now, let's face it, Bank of America, Wells Fargo, JP Morgan, they're basically extensions of the government. So if we could go back to free banking that we had in the 1800s, yeah, I'd trust the banks, because all those loans, they'd have to keep them on their balance sheet. No one's there to bail them out. But now, no, I don't really trust the banks. But you bring up a great point. We were talking initially about what may be motivating Jerome Powell to take a huge risk to his reputation, for the next, and how history is going to remember him by doing this pivot. But he could be looking at the health of the banking system with the BTFP. And so just as a reminder for your viewers, back in March, when Silicon Valley Bank went bust, the Fed kind of set up this special program, another tool that they have. It's called the Bank Term Funding Program, I believe is what it stands for. It's the BTFP. And when that was set up in March of 2023, when all these banks were going bust, Signature, First Republic, et cetera, the utilization of the BTFP went straight up to 60 billion. 60 with a B, because what this was doing was allowing these banks to take the treasuries that they owned, that they took a haircut on because interest rates went up, giving them to the Fed and getting 100 cents on the dollar. So if this BTFP is being utilized, that tells you it's kind of like a proxy for the health of the banking system. Well, most people think that BTFP is no longer being utilized because we don't hear about it anymore. To your point, we think that the Fed came in on their white horse, saved the day, and now all of a sudden we've got nothing to worry about. Oh, that banking crisis. Oh, yeah, that's old news. No. If you look at the BTFP right now, it's at an all-time high as far as its utilization, and it actually just spiked up. So just to give you some context there for your viewers, back in March of 2023, when we had all these banks going bust, the utilization went straight up to about 60, maybe 65 billion. Wow. Today, it's at 120.
Wow.
120. So you could argue that the system is twice as bad as it was in March of 2023. That could be another input to Jerome Powell's decision-making process. And oh, by the way, that was a temporary program, Daniela. I don't know if you knew that. It was only, in fact, it ends March 11th of 2024. So think about that. If it's being utilized at an all-time high right now, and it's going up and up and up and up, and this is a proxy for the health of the commercial banking system, and that program ends just in a couple months, I think the probability is very high that the Fed's going to extend that program another year, but that, again, could be going into the decision-making of Jerome Powell right now.
So we could possibly be facing a banking crisis 2.0 in 2024. The
Well, you have
likelihood,
to
I mean,
think about this, right? Would any of your viewers argue that we would not have had a banking crisis or a GFC 2.0 if the Fed would not have bailed them out in March of 2023? No one would argue that. Everyone, I think, would say, yeah, absolutely. If the Fed would not have stepped in, then we would have had a GFC 2.0 in March of 2023. I mean, if you just take the balance sheets of the banks that did fail, Daniela, all of the balance sheet, the assets were larger than the banks that failed combined in 2008. So it would have been catastrophic, right? And now we have to realize that BTFP is being utilized to a greater degree, twice as much as it was in March 2023. So if they did a rug pull on that BTFP, I can assure you we would go straight into something that would look a lot worse than what we saw in 2008 and in 2009. So and the reason I'm pointing that out is just to show you the fragility of the system right now when we think that the problem has been solved.
wow. You just made an incredible case right there. That was yeah, that's really eye-opening. I mean, George, I guess just to wrap, because I know we covered a lot of points here, but so I guess heading into the new year, I mean, would you say that's the number one risk the financial system is facing, is that fragility of the banking sector? Would you place it in the number one spot?
I don't know that I'd put it in the number one spot because you got World War III that could be an option. I mean, I don't even like to think about that, but we have to be realistic.
Of a full-on world war.
Yeah, absolutely. Look what's happening in the Middle East right now.
Of
You
course.
don't think that could turn into World War III? Absolutely. And China, Taiwan, Russia, Ukraine, who knows? I mean, the geopolitical risks right now are absolutely staggering. And then from just a global economy, look at what's happening in China right now. They're going through quite literally deflation, not disinflation, deflation. So how is, what type of systemic risk are we going to see with China? In fact, I was reading a statistic the other day that will completely blow your mind. They said that they have, and I don't know if this is accurate or not, but they said on the high end, I think Kyle Bass was talking about this actually, that on the high end, they approximate that they have 3 billion with a B, empty apartments right now in China. 3 billion. They only have about 1 billion people, but yet they have 3 billion. I don't know if they're empty, but let's just say 3 billion.
Or the size of them.
Apartments.
But yeah, that's.
So think about, you want to talk about a real estate crash. My goodness gracious. And I mean, that dwarfs what we saw in the United States in 2008. So if 2008 can create a global financial crisis because of the systemic risk, just think what China and their 3 billion apartments, how that could impact what's that?
What this has me thinking, I mean, your talk of this, real estate crash or World War III, all of a sudden central bank digital currencies doesn't sound so terrifying anymore, George.
Well, then yeah, you've got that problem too. But I think that's what the yield curve is telling us, Danielle. And I think for your viewers who wow, this is way over my head, or George is just, I don't even know what he's saying. Just all they have to do to keep it super, super simple, just use the KISS strategy, keep it simple, stupid, is you just look at the 2-year Treasury yield and the 10-year Treasury yield. That's all you have to do. I'd like to encourage your viewers just to do that maybe once a week. And then just wait for the 2-year Treasury yield to go lower than the 10-year Treasury yield. Because what we've seen throughout history is when the curve inverts, yes, we have a hard landing, but we don't have that hard landing until the curve is no longer inverted. The hard landing, or the crisis, the collapse, whatever you want to call it, that rarely happens when the curve is still inverted. So you just sit there and wait till that curve uninverts. Another timing signal is when the Fed drops rates for the first time. Not all the way down to zero, but when they drop that first time, usually just a few months after, that's when the official hard landing, the official recession starts. So just watch that yield curve like a hawk and know that when it uninverts and or the Fed drops for the very first time, that's when you should be, in my opinion, that's when I personally will be extreme risk off. But I'll be waiting for a great opportunity, because the bigger the crisis, the bigger the opportunity.
Well, I was going to say, I always want to end it on, well, let's just not watch it, but, how is George Gammon prepared, right? So that when it does hit, you're like, I'm good.
Yeah, so right now it's T-bill and chill. It's T-bill and chill for George Gammon. So literally 90% of my portfolio, I have a model portfolio in my subscription service. 90% of the portfolio is T-bills, and then 10% of it's gold.
I know you love gold.
And so what I'm doing is I'm just sitting back watching that curve like a hawk, like we discussed. I'm being as patient as I possibly can. One of our favorite people in the world, Jim Rogers. And he's my favorite investor, one of my favorite people, period. And I always remember what Jim Rogers told Jack Schwager in the Market Wizards books all the way back in the late 1980s, 1990s. He said, what I do is I sit, I do nothing. Nothing. And I just wait for a big pile of money sitting in the corner. And when I see it, I just go over and pick it up. So that's what I did in 2012 with real estate. That's what I did in 2020 in March with commodities and several other stocks. And I think we'll likely, again, no certainties, only probabilities, but I think there's a high probability that we're going to be able to do that again in 2024. So it's T-bill and chill, hold your gold, wait for the curve to uninvert, wait for the Fed to drop rates for the very first time, and then analyze, understand why they're dropping rates. What is the crisis that's forcing them? They're not going to do it by choice. They're going to do it because they have to. What's causing them to do this? And then what are the opportunities that will result from that crisis? Understand them, wait for stuff to get cheap, then go ahead, sell the T-bills, take the dry powder, then take action and build a portfolio that you want to hold long term.
When you were speaking about Jim Rogers, I remembered a great memory I have with him. We were doing a show in Las Vegas, and I happened to be walking on the strip with my team, the Las Vegas Strip, and Jim Rogers was in front of us. And, he's so iconic with his bow tie. But here's this image of Jim Rogers, right? He was walking with his hands behind his back and just taking it by himself, right? And just taking it all in. And I remember thinking in that moment, like, what the heck is he thinking? And I had a chance to ask him later, but, he was just observing it.
Yeah.
Like I've never seen anyone observe something completely different, right? Like we're just walking the strip, but his mind is, who knows where it was, but great Jim Rogers. It was just an iconic and memorable moment. George, I know you're going to your holiday dinner. I want to thank you for coming on, and I want to wish you a very Merry Christmas.
Oh, likewise. Merry Christmas to you. Merry Christmas to all the people at ITM. Tell Lynette I can't wait to see her again.
And you have your big show coming up in May. So
yeah, the Rebel Capitalist Live. We've got that coming up, and maybe we'll see you there with Lynette.
Yes, hope so. I hope so. And thank you all for watching. I want to wish each and every one of you a very happy holiday season. Merry Christmas. Happy New Year. Only good stuff coming your way. Be sure to stay tuned to the Daniela Cambone Show. We will be back January 3rd with brand new content, and you could sign up at danielacambone.com to stay on top of it all. That's it for me. Thanks for watching.
And watch that yield curve.
There you go.